Hello everyone. This is CA Minds, Easy CA Coaching. Today we are going to the part 2 of company accounts. Well, in part 1 we have discussed about what is a company and the salient features of the company and the liability of the members of the company. Today we are going to learn about what is a share and what are share capital and types of share capitals and types of shares. So, what are you waiting for? Let's go. Share capital. What do you mean by share capital? When the total capital of the company is divided into small units of fixed amount. Then it is known as share capital of the company. Then types of share capital. The first type of share capital is authorized, issued, subscribed, and the fourth and fifth capital is called up and paid up share capital. What is authorized share capital? Authorized share capital is the total capital of the firm estimated by its company and is registered in the memorandum of association with the registrar of companies. What is issued share capital? It is the portion of the authorized share capital such that a part of authorized share capital is issued to the public so that the public can subscribe the shares of the company. Then what is subscribed share capital? The portion of issued share capital which is subscribed, that is which is purchased by the people, then it is known as subscribed share capital. The shares are issued at face value. What is called a paid capital? Generally, when public purchase shares from a company, then the general system is the public pays pays for purchase of shares in installments like application money, allotment, first call, final call. When the company calls up these these uh, these types these installments, and this is called as called up share capital. Then what is paid up share capital? The amount required for a share capital which is not paid by the public is known as uh, unpaid calls or unpaid share capital or calls in arrears. Now the next concept is types of shares. Preference, equity shares. What are preference shares? Well, according to Section 43 of Companies Act 2013, person holding preference shares are called preference shareholders are assured of preference dividend at a fixed rate during the life of the company. Well, highlight the word preferential dividend at a fixed rate means when a company is at a situation of losses, or when it is a situation that the company has gained many profits, the company is supposed to pay them only at a fixed rate which is decided as per the Companies Act 2013 when there's an when there's unless an agreement to contrary. So during the winding up of the company, the preferential shareholders enjoy two benefits: payment of dividend repayment of capital. Whereas the second type of share is equity. In equity shares, there's no the company gives more dividend in the case of profits, unlike preference shares, but they do not enjoy the benefit of payment of dividend or repayment of capital in the case of winding up of the company. The shares can be issued in cash or any other consideration. Whereas in preference share, you should only issue on other than cash, only on consideration. So let us go to the journal entries.